Well, welcome to our video based on the material from the book that you've read, Investing in the Second Lost Decade. I want to thank you for purchasing that book and reading it. We hope that the video will help give you a better understanding of our secular views and the business cycle methodology that we use to manage portfolios. It features many of the charts that are in the book, but this time in color and animated versions to help relay the message. I'm Tom Kopus with Pring Turner Capital Group, and again, thanks for viewing. As the first decade of the century came to an end, there were many articles written that looked back at the lost decade. And our view was that there was an untold story, that in fact there was another lost decade ahead. Generally, if we look back in history, lost decades are followed by second lost decades, or often these difficult periods can last 20 years or more. Our hope was to help explain the environment so that investors would be in a better position to understand how to deal with a structural secular decline such as we've had since the year 2000. And since 2000, we've had plenty of ups and downs. A tech bubble that burst, a real estate bubble that burst. The stock market actually had two declines, one of 50%, another one of 60%. So indeed it was a difficult decade. Some folks might say, well, we've never seen a market like this. We would say that if you studied history long enough and far enough that yes, we have been through periods like this before. And it's really not all that different from historical precedents. If we look at this first chart of the typical retiree nest egg through a lost decade, what we'll find is our family, the Smiths, that they may have done a great job of saving and compounding, and possibly with contributions from retirement plans and their employer plans. In their accumulation phase of their life, they also enjoyed the benefits of a secular bull market, or higher and higher stock prices for an 18-year period. When they finally decided to retire in the year 2000, they made the assumption, well, if I took $1 million of my retirement portfolio and put it in the stock market, why, I should be able to draw down just 5% of that each year, or $50,000 a year, so that over time they can not only supplement their retirement income with distributions from their retirement account, but also continue to build capital so that over time they might be able to offset inflation. So they had some realistic goals and realistic assumptions. The problem is something changed at the end of the century that they hadn't anticipated, and that is we went from a secular bull period for stocks to a secular bear period. And could see the impact on their $1 million nest egg, taking into consideration a lost decade where stocks have averaged with dividends less than 0.5% per year, and based on taking equal amounts out every quarter of $12,500, that lo and behold, their balance here in the end of 2011 is only $330,000. So how much longer can the Smiths continue with that game plan? We believe the key to surviving secular bear periods is first to understand the environment that you're in. With that, you can then adapt your tactics and strategies to adjust for it. So we'll spend some time in this first section of the video showing you the characteristics of secular bear markets, what they look like, how long they last, when they might end, and also give you a framework for a strategy to use to not only survive but protect yourself through these difficult periods. Now, in terms of absolute prices, in the long run, the stock market goes up. We're not going to argue with that truism. This chart of stock prices going back to 1900 is in absolute price terms. In other words, there's no adjusting for inflation. It's just pure pricing history. This is not a total return chart, just price return chart. And what you'll find in these very long term, market goes up, but also you'll find that there are alternating long-term periods of good and bad market performance. Here we've labeled 3 prior secular bear periods, and currently we believe we are in the 4th secular bear period since the year 1900. Now, if you look carefully at bear period number 1 and 3 in this chart, they may look relatively tame, but keep that in mind when we go to our next chart when we show stock prices on an inflation-adjusted basis. So here in the next chart, we have the same data, but now it's inflation-adjusted. The red highlights in the pricing chart actually represent periods when the U.S. economy was in recession. This is to give you an idea of the cyclical nature of the economy and its relationship to the stock market. So there are bumps along the way every few years, so you'll see the deeply cyclical environment that occur during secular bear market periods. The bottom half of the chart is actually a Shiller P/E ratio. Dr. Shiller, the famed Yale economist who wrote the book Irrational Exuberance back in the late 1990s, is kind enough to share his data on his website of past market history, earnings, inflation, dividend yields, and so forth. And we were able to use that information to build this graph for you. The key point in this chart is that secular bear markets start at overvaluation levels. In this case, overvaluation is defined by the Shiller P/E, which is a 10-year rolling average. It's not just based on 1 year's earnings, but on a 10-year average of earnings. And Dr. Shiller did this to smooth out the fact that earnings will fluctuate during business cycles. As the economy grows or goes back into recession, earnings are affected. So by looking at a longer-term 10-year average, he believes you get a better view of valuation levels. So secular bear markets start at overvaluation levels. That's we define as over 22 times earnings. You can see the 3 prior secular bear markets and the current one. On the other hand, secular bull market periods start at deeply undervalued levels, generally in the single-digit P/E level. And again, you'll find the 3 other secular bull market periods that began in 1922, 1949, and 1982. The secular bear periods each had their own characteristics. The first one lasted 19 years. There was a 69% decline, and it included 6 recessions. The second one was 19 years, a 67% decline, and 4 recessions. The third one, 16 years, 62% decline, and 4 recessions. And so far, this current secular bear is over 11 years long. There's been a 34% decline, and we've had 2 recessions. So we are almost 12 years into the current secular bear market period, and we believe before it's all over, we're going to fully move from one extreme to the other, like a pendulum, and go back into the single-digit territory sometime in the next 5 to 10 years to reach that undervaluation level again and set up the environment for the beginning of a new secular bull market. Now, another way of looking at this data is to view our overlay chart. The overlay chart just simply plots each of the secular bear periods on top of each other, and so you'll find the 1900 to 1919 period, the 1929 to 1949, and the 1966 to 1982 secular bear periods. They all traced out their own pattern, but in the end they all gravitated to the bottom right corner of the chart, and on average lasted a little over 18 years. There were more than 4 recessions on average. PEs started at an average of 27 times earnings, but by the end of the secular bear period, they were down closer to 7 times earnings on average. and the inflation-adjusted decline was almost 66%. In comparison, so far, we've been just under 12 years, 2 recessions. We started the PE at 44 times earnings. We're down to about 21 times earnings as of the end of 2011. And the decline so far has been about 34%. So we have come a long way, but we do believe there's more time involved and more business cycles to continue to work off the excesses of the prior secular bull period. Of course, secular bull markets don't come around very often. The last 2 secular bull periods began in 1982 and 1949. So we're saying the next one will begin from very low valuations and set up a terrific opportunity for investors who are in a good position to take advantage of it. Our goal with the book is to help you survive until then so that you can take advantage of the next secular bull market. So some might question, well, boy, single-digit PEs, how could we ever get to that kind of a low level? It seems kind of extreme. And one way to envision it is to look at this next chart where we compare the stock market to commodity prices. This is what we call an intermarket relationship, and Martin Pring spent a lot of time analyzing the relationships between different markets, and we believe this chart is a very constructive one, an important one to look at, and also might explain how we would get to lower PE levels. This top chart is again our U.S. stock prices, inflation adjusted. This chart in the middle is the commodity index, and what you'll find with commodity prices, they tend to move inversely to stock prices. Historically, when the stock market is in a secular bull market, commodities in a bear market are moving sideways in a relatively tame environment for commodities. In other words, with lower rates of inflation, we get higher and higher PE ratios and higher stock market. So as we can see, the prior 3 secular bear periods for stocks included periods where commodities were in secular bull markets, and sure enough, stock market in this 4th case has been going down since the year 2000, and commodity prices have been in a secular bull market. As you can see, the charts clearly show that pattern is holding still today. And if you look at gold prices, oil prices being up over $100 a barrel, for instance, it does sound familiar. And it does make sense that as oil and gold and natural resource material prices go higher, that might put pressure on companies and their ability to pass on these higher prices. The bottom chart is a very long-term oscillator. It's actually a 60-month divided by a 360-month long-term momentum oscillator, and it's designed to pick up the secular turning points in commodity prices. And at today's level, we see it still moving higher, and we would suspect that it will continue to move higher well into the next decade. If we get to a point where commodity prices are stable once again, stop rising, maybe decline, that would be an environment that would turn the stock market outlook to a much more positive one. So now the reader might be thinking, holy crap, how are we going to make money in this kind of an environment? Stock prices are doomed, commodity prices keep going higher. How is it possible to make money in a secular bear market environment for stocks? Well, as we have mentioned earlier, the characteristics of a secular bear market is that you'll find them to be deeply cyclical. In other words, there are economic ups and downs. So even within a secular bad period, there are shorter term periods or cyclical periods where the markets can behave well and cyclical periods where they can behave poorly. This wave chart shows the moves of 25% or more. For instance, this first secular bear period, 1900 to 1920, didn't just go straight down. It included multiple waves down, and then up. So there was a wave 1 down of 30%, a wave up 2 of 53%, a wave 3 down of 51%, a wave 4 up of 56%, and so forth. So as you go through these periods, they're really made up of many cyclical up and down moves. By the end of it, investors made no progress unless they've paid attention to these cyclical moves, went on offense at the right time, and then took defensive tactics during the difficult periods. Secular bear markets are known to have more recessions and more business cycle swings. So what we've been seeing in the current secular bear, not too surprising. Secular bull markets are pretty easy, on the other hand. In fact, look at the period from 1920 to 1929, period from 1949 to 1966. You had an entire secular bull move without any 25% decline along the way. The 1982 to 2000 period did include the 1987 stock market collapse of 35%. Interestingly, that was not related to a business cycle event. The economy did not go into recession, but that was the only decline of 25% or more in that period. So secular bull markets are pretty easy. Secular bear markets are hard work. Takes a different set of tactics. Secular bull markets, you can sit back and buy and hold, buy the dips, works out just fine. Secular bear markets, on the other hand, you need a different set of tactics. So you can imagine at the end of a secular bear period, it's a really grinding process. Multiple moves up and down, not getting anywhere. Really wears on investors' nerves and their psyche. And so the psychology at the end of a secular bear market is one of frustration, disgust, not a lot of hope or optimism about the stock market. And that's what sets up the secular good period. Secular bull markets, on the other hand, end with a lot of optimism. Everybody's a genius. The market only goes up. Buy and hold is all you have to do. And of course, that ends up being a frustrating strategy as you move into the secular bear market environment. So to recap the key points on secular trend for stocks. First, there are long periods of alternating good and bad market performance. 2, secular trends change at extreme valuation levels. 3, currently we are 11 plus years through our 4th secular bear market since 1900. Be aware of the commodity secular bull market. Take advantage of those opportunities. Capitalize on cyclical stock market opportunities. So there is a time to go on offense and a time to go on defense. Inflation is a stealth tax, and you want to be on alert. That commodity message clearly says that prices and inflation will only accelerate as we move ahead here in the next decade. And finally, understanding the secular environment is really the key to success. If you have an understanding of the environment you're in, you can change tactics and adapt to that environment. Thanks for listening to this video on the secular trend for stocks. We welcome you to check out our video on the business cycle and how you can use it as a tool to navigate through the secular bear market for stocks that we believe lies ahead.